Hey, this is Hutch with bankingtruths.com, and today we're going to explore a very controversial topic in the infinite banking space. Can IUL, or Index Universal Life, can it work for IBC? Now, before we get into all the heated opinions, I want you to put on your critical thinking cap for just a moment, and I want you to ask yourself, can Index Universal Life, can it help maximize your long-term liquid compounding? And can it also bolster your strategic leverage? Because at the end of the day, that's really what infinite banking is. You're taking one asset, whole life insurance, you're keeping it compounding, you're stripping liquidity from it via loan to keep it compounding, and you're doing so in a way where hopefully that loan doesn't infringe upon that growth in any way. And I would contend that it's not an either or conversation like what's better, whole life or IUL, but there are some unique features of each, including Index Universal Life, that can help bolster a comprehensive infinite banking strategy. So let's get into the opinions. Before we do, I want to ask you what this is a picture of. So this is actually an echo chamber. And when I started asking these questions, it's over a decade now. This is like 2011, 2012, where IUL was really hot in the market, but not so with infinite banking, the scene that I was in, a lot of the other online marketers, some of the greats that are now passed away. I remember being at a conference and talking with some of them because I started to play around with the illustration software just to see what was going on and if it was as bad as everybody was saying. And the opinions I heard from a lot of different people in the same space was pretty much the same opinion, that with IUL, you're losing the guarantees of whole life. So pretty much you're guaranteed for it to go to zero and you're going to lose all your money. The insurance company can change certain things, so they're going to change the game on you 7 different ways and you're going to be screwed. If you don't get the performance or you have a few years of market losses, then the whole policy is going to blow up on you. Things like this that were very, very sensational. And thankfully, I actually took to the math and started exploring the product on my own. And I actually ended up buying several of these products on different family members from different companies. So I actually have the benefit of hindsight for well over a decade now, which turned out to be some of the roughest testing grounds for IUL. And I can tell you it's not all roses, but that the same is true with what we saw for whole life in a very rough time for life insurance in general over the last 5 years, is that the companies that did too much overpromising definitely underdelivered, and consumers were definitely not left in a good spot. This happened with certain whole life companies as well. The insurance companies did have to change the gains because interest rates were a lot lower than originally projected. But the ones that were designed properly, and even some of them I underfunded because I didn't know if this was going to work out, they didn't blow up like everybody said. I did get down years and wasn't even close to blowing up. I did underfund and I could probably skip several more years. So I learned a lot, and this is what I want to share with you in this video. So I recently put out a new video series called 4D Banking, or the 4 dimensions of banking. And I'm talking not just about 4 different types of asset classes you can use in a comprehensive infinite banking strategy, but also the 4 facets or dimensions within each assets to maximize growth, minimize loan drag, and also minimize taxes while maximizing liquidity. And so I thought I'd run IUL through these 4 facets to see how it does. So its tax exposure, obviously it's at the cream of the crop with whole life because it's pretty much tax immune. With growth, whole life is guaranteed to grow every year. IUL is not. However, in the years it does grow, because it's tied to an outside market index, you do have the potential for it to outperform whole life over time. Now, this does entail that an Index Universal Life policy is chosen, funded, designed, and monitored properly. Something all 4 of those steps are often missed by consumers wooed by bright, shiny objects. Also, the ongoing risks and volatility. So I'm not here to say it's all sizzle. There is definitely additional risk that you take on with IUL that you don't with whole life. However, these risks can be managed again with those 4 different factors: choosing the policy, funding it properly, designing it properly, and monitoring it properly. We can really mitigate these risks. And last is the triple L for 4D banking: liquidity, leverage, and loan rate. So liquidity is very similar to whole life. Leverage the LTV, you can get about 95% loan to value, which is better than non-insurance assets across the board. And the loan rate is very, very interesting because whereas we're seeing whole life loan rates drift up, and now the Fed is saying that we're probably not going to have lower rates, we might even have higher rates. IUL does offer, certain ones offer a locked loan rate for life. So imagine, I tell this to business owners who often use line of credits, real estate investors too. What if your banker came to you and said, how'd you like to lock in your line of credit for life somewhere in the 5 to 6% range? And they like that very much. So I'm not saying I like my IUL policies better than my whole life policies, but what I am saying is over the last 12 years where I've owned both, there's been times where I enjoy the unique features that IUL has to offer as I'm deploying my comprehensive 4D banking strategy, allowing all my assets to compound while still keeping them liquid and safe through that strategic and defensible leverage. Now, bringing it back to traditional infinite banking, you don't want to be on this saving, spending cycle that's all you can be on with high yield savings. But with life insurance, you can keep your cash compounding, borrow against it, end up at a higher place in line. And as we look at IUL and whole life compared to high yield savings, you open up other dimensionality with that arbitrage potential, with the ability to keep the assets compounding while borrowing against them. For the better part of the last 3 decades, you were able to get positive arbitrage using whole life. And we probably will again, if you look at the violent nature of the spikes as we've had in the recent past, they don't last long. And I've said this many times that the Fed is going to have to play ping pong between raising rates to tame inflation and lowering rates to keep us out of a recession. But to be able to have another asset class where you can still access 95% loan to value and guard against losses and be able to lock in your loan rate at a 5 to 6% level and still be able to earn positive arbitrage because index universal life's growth is not tied directly to rates, it's tied to an outside index. So let's take a look at that. So this schematic is from a mutual fund company. I do want to disclose that the returns here showed for the last 86 years. This is the total return of the S&P, including dividends, and IUL does not include dividends. However, this is just for a concept. And we can see intuitively if IUL is a good proposition for infinite banking. You can see I have a 10% cap, a 5% loan rate, and a 0% floor. We're going to look at this through the S&P's history over the last 86 years. Before we do, I just want to say also, there's a lot of these newfangled algorithmic indexes made by investment banks. I'm not going to name any names, but the very popular names out there are putting out these algos, and they have greatly underperformed. So I would strongly recommend you use a company and a product where it is mainly based on the S&P, so it is transparent and you understand how it works and you can look at the rules. But with this 86-year history, what we can see down the bottom right is 65 years of the 86 were positive, 21 were negative. So what that means is the S&P is up actually over 3/4 of the time, and it's down only 1/4 of the time. So if you're looking for long-term positive arbitrage with a locked loan rate, I would just say intuitively, this can be attractive. Now, is IUL missing out? So a lot of people are saying you're going to do better in the stock market. And I agree, you probably will do better in the stock market. But again, you're not going to have 95% loan to value. You're not going to be capped on your losses. However, it is a valid criticism to say that the S&P will be above an IUL's cap over 50% of the time if we look at this history. However, there are certain companies out there that do give you uncapped S&P strategies. Some of them have a hurdle rate. Some of them give you a participation rate where you don't have full participation in the S&P, but you might get around, say, 3/4 of the S&P from $1. And this can be very attractive, especially if there still is a floor that limits your losses. And that is the main value proposition of IUL, is over stocks per se, because with 4D banking, I do talk about borrowing against stocks in conjunction with using insurance to protect them. IUL still protects against the catastrophic losses. And so with IUL, even though there's no market losses, they say it's a 0% floor, you still do pay fees. And if you're borrowing, you still do pay loan interest. But by maintaining your losses, so to speak, or at least just your erosion of cash value to low single digits, you don't need to catch up that much. And if you have a policy where you have true S&P uncapped participation, even if there is some kind of hurdle rate or even if there is some kind of watered down participation rate, well, if you look at those two blue bars on the far right, you could still easily make 17, sometimes even 30% to the upside while limiting your losses. And think about it this way. IUL has something called annual reset, where when you lose, or excuse me, the S&P loses and they just give you 0, you start from that new lower place in line, even though you locked in your loss to just whatever the insurance fees were and the loan interest. Conversely, with stocks, you do have unlimited upside potential. However, you also have full risk of loss. You have a lower LTV. You can't borrow 95% loan to value against your stocks. You can borrow 50, some brokers 75, but you'd be crazy to even get close to that because stocks are very volatile. And if you go below that number, like if you have 51% LTV, the broker is just going to sell your positions at their lowest point to go ahead and make up that margin call. You have floating loan rates. There's very attractive loans right now with stocks. You can also deduct them naturally, regardless of what you're using for. Even if you're using them for cars, college, vacations, the things you can't deduct, since it's carrying investments, you actually can deduct those against investment interest if you are itemizing your deductions. And last, the tax exposure. Obviously, you're still subject to capital gains, qualified dividend treatment, but at least at this point, these are still favorable rates. But again, the losses, if you lose 25%, which can happen, especially if you're dealing with individual stocks very quickly, you need to make 33% just to get back to even. If you lose 33%, you got to make 50% just to get back to even. There is no annual reset feature with stocks. And that's why we recommend having insurance to cushion if you're borrowing against stocks, whether it's whole life or IUL. In this case, I actually prefer to have a base of whole life because it's truly non-correlated. And obviously IUL, even though you limit your losses, it still is somewhat correlated. IUL though, it does limit your upside to the market. Like we've talked about that. However, the pros are you substantially limit your losses like we've talked about, right? Just keeping them to this low single digits. It's all upside from there, from that lower point where, usually after a crash or snapback rallies. And so you're more likely to hit caps or get some nice uncapped strategies after losses in your IUL. 95% loan to value. That's tough to argue with, especially when you have some guardrails. So as long as you're servicing that interest, you're not going to get a margin call. Your policy's not going to blow up. Locked loan rates. I mean, this is just massive. It's really the only way to do it with any asset other than, say, a 30-year fixed mortgage. And you get to erase taxes. It's just completely tax sheltered as long as you don't implode the policy or lapse it in your old age. Let's talk about the downsides, though, because IUL is not all rainbow. There has been a lot of sizzle sold out there, a lot of over-promising and under-delivering. Let's talk about the downsides and how to manage them. So I will say that a lot of the criticisms, especially within the infinite banking community, love my people, but sometimes they're overstated, whether they don't understand or they're really just trying to push you to the wares that they're comfortable selling. The commission hit. The thing about the commission hit with Index Universal Life is they actually keep your money working in the policy and they amortize that over 10 years. So with whole life, it is just kind of 1 year. With IUL, you actually still continue to have the bulk of your money working in the market. They're not going to let you borrow against it because they do put surrender charges, which we're going to talk about, but it's still working for you in the market. So some of that commission hit, you have the ability to compound and earn your way out of it because they do amortize it over 10 years. You're not, the indexes are not paying S&P dividends. This one's kind of smoke and mirrors. Like it's not because the insurance company's keeping the dividends. They're not. The way they do this with IUL is they're using option strategies. And anytime you're dealing with options, it doesn't include dividends. So basically the insurance companies are net buyers of S&P options and they just track the index, not the dividends. So there's no shenanigans going on. There's no whatever. And quite frankly, if you own stocks that pay a dividend, when they pay a dividend, the index goes down. So it's kind of silly, actually. The the insurance company's keeping all your big gains over the cap. It's not true. Like I said, they're using option strategies. However, what they're doing is they're buying those options and then they're selling out of the money options, almost like a covered call, if you've heard of that, to bring down the cost of the option so you can get 100% participation of the S&P. And people will say you're better off investing in an S&P 500 index fund. And I'll tell them in the long term, you know what? You're right. However, for banking, like people love to pit things against each other. It's like S&P's better than IUL. Okay, well, like that's judging by the marathon. But if you're talking about using it as your own bank, you need money now. If you're in an S&P index fund, you're not going to sell your stocks when they're down or borrow against your stocks when they're bleeding without some kind of protection like insurance just to buy real estate that's down. So it's kind of an apples to oranges comparison. We're not saying you should replace the S&P with this. What we are saying is you should complement with this, and this should not be trying to beat the S&P. You're trying to beat the bank, really, with where your current liquidity is. And you're going to have more of it if you do this. That being said, for clients that are super risk averse, we do have them. They're just scared of the volatility of the stock market. In this case, I'd rather see them have an IUL with some exposure to the S&P than nothing at all. What about the valid criticisms of IUL? There are some. Let's talk about them. However, I will say that if you choose the policy, design the policy, fund the policy, and monitor the policy properly, another 4Ds, another 4 dimensions, you can mitigate a lot of these. And the first one is the early surrender charges. So we talked about that. Think of it like a vesting schedule because it really acts like that. So some of you at work have a profit sharing plan, or you're business owners and you give your, you just give, not a match, you just give some of your employees profit sharing. Well, usually it's over a 6-year graded vesting schedule, which means they get to go ahead and invest that money. But if they leave early, then there's a clawback. And it's the same thing with IUL. We should be designing this thing so it lasts for your whole life. Subpar long-term growth strategies. This is really, really important. I've talked about them before. There's all these algorithmic strategies out there that just sound too good to be true. Like they're going to move you from stocks to bonds and the algorithm's going to do this and that. They've greatly underperformed. They're by investment banks. I'm not naming any by name because they've all underperformed. And the reason why is, one is you want the volatility. Like you want to be in the market during those volatile days. Like you've seen those things about missing the best days in the market. Well, if these algos are moving you out, you're probably going to underperform. The lack of guarantees. So the rising insurance cost is a real thing in IUL. When we look at the rising cost of insurance, if you max fund and you get good performance, it should naturally lower fee drag. So what the schematic is we show the death benefit rising in the early years when you're funding. So you have a level amount of death benefit, but then after that, we flatten the death benefit. And you can see with index crediting, the delta between the cash value and the death benefit shrinks. And so even though the cost per unit of insurance is going up, you should be paying for less units of them. And we get to a point where we can't even shrink it any further. And then what happens is the cash value growing actually pushes up the death benefit. And I made it like a wedge because it's really like that. Like the cash value pushes up the death benefit because you have to, so it doesn't turn it into a mech. You have to maintain a certain corridor of death benefit. However, every year you get older, you need less and less death benefit to do it. By the way, you don't have to do that manually. The insurance company automatically does that once you hit corridor. Long story short, why have a high yield savings account, right, when you can use a combination of whole life and index universal life and get that arbitrage potential? That's what this is all about. Keeping your assets working for you. I know people don't like borrowing, but when you're getting excess growth that you normally wouldn't be getting, those times where you have to borrow against it, you're usually going to be way ahead of the game. And just like we see with the picture, as you pay down the loan against your continually compounding assets, you actually end up in a higher place in line. Not saying that IUL is better than whole life. Probably will do some videos talking about both. But again, I'm actually recommending that you look at both. And maybe if you already have whole life, there's a time to look at IUL. If you want both, maybe you start with one or the other. That's all something we can talk about in a custom meeting. I'd advise that you just book a time on our calendar and we can educate you about your options and you can see what's best for you. Hope you enjoyed this. We'll talk to you soon.